Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. One of our favorite things about real estate is that you can work together with other people to do bigger and more impactful deals. Today we'll start a series we're calling The Summer of Syndication, and we'll talk about finding deals, proper due diligence, and protecting the capital. And we've got a great guest on the Real Estate Guys radio program. The Real Estate Guys are throwing a party and you're invited. Join us at the New Orleans Investment Conference, November 1st through 4th. Now in its 49th year, it's the world's longest running investment conference and features some of the biggest names in economics and investing, including James Rickards, George Gammon, Danielle DiMartino Booth, Rick Rule, and Peter Schiff. The Real Estate Guys are speaking in multiple sessions, attending lots of others, and we're hosting an invitation-only party one of the evenings for our friends and listeners, including some VIPs for you to mingle with. So make your plans to join the Real Estate Guys at the New Orleans Investment Conference. With all that's going on in the world, no serious investor can afford to miss it. Send an email to neworleans@realestateguysradio.com and we'll get you all the details. That's neworleans@realestateguysradio.com. And we'll see you there. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Joining me, as usual, our financial strategist and co-host, Russell Gray.
Hey, Robert.
It is no secret to our listeners that we're fond of the idea of taking lots of folks with their various gifts, bringing them together to have something even bigger and better, whether it's a mastermind concept or doing bigger real estate deals. And it is time for us to embark on a series. We did these over the years, and this summer, the series is The Summer of Syndication. We think that raising capital to do bigger deals is an awesome opportunity, but it's also an awesome responsibility. And so over the coming weeks, we're going to introduce you to some folks that have crossed over the line from investing in their own account to now raising capital to do bigger deals. It gives you exposure to more markets and bigger properties. It gives you economies of scale, lets you hire better teams, but it also means that you are responsible for other people's money. It's a big topic, and we're thrilled to be sharing these next few weeks with you.
I think one of the things that people innately want when they think about making money, going into business or investing, the big dream is to become financially free. And it's not really the finances they want, it's the freedom that they want.
Yeah.
And when you think about freedom, what I always taught my children growing up is the flip side of freedom is responsibility. Freedom and responsibility are two sides of the same coin. They go together. You want more freedom, you need to be more responsible. Of course, if you want more riches, you're going to have to be more responsible. And then those riches then give you the freedom as long as you're in a system where you're allowed to own private property and you have the rule of law and all of the things that we love about the Constitution in the United States of America in particular, but any place where you're allowed to have that opportunity. So responsibility is very, very important. And so when you talk about capitalism and going into the marketplace and exchanging value for value, if you really think about what being a salesperson is, when you're going to sell something, you make somebody a promise. I'm going to deliver this product or service, this experience. I'm going to solve this problem for you. My product or service will solve the problem. You talk about those old traveling salespeople, the snake oil salesmen, they would sell you a solution based on a promise, but they wouldn't deliver. That's not capitalism. That's thievery. That's being a ripoff artist. Now, there are times when people in good faith try to create a product and the product goes bad for some reason, and that's just the liability of being in business, buyer beware and all that kind of stuff. But the essence of capitalism is to go into the marketplace, seek problems that you can solve those problems, and get rewarded value for value for providing the solution. And so in order to do that, you have to be good at identifying problems, keeping promises, delivering on services, being responsible to keep your word. And when you do that, then you earn your money. And that's exactly the essence of the entrepreneurial opportunity of syndication. You help people put their money to work, and when they hand their money over to you for you to deploy it and manage it, you take on tremendous responsibility.
I think the essence of syndication can be summed up in one of my favorite Zig Ziglar quotes. You can have everything you want in life if you'll just help enough other people get what they want. And it really puts the emphasis on the other people. Absolutely, you can make a great living as a syndicator. You can make a fortune as a syndicator. And over the next few weeks, you're going to meet a lot of those folks, including a gentleman today who has done quite well. But it comes by being prudent, by being a good steward, by being a good student, and by doing good, solid business. When you just invest in your own account, let's face it, sometimes you take shortcuts. Sometimes you make decisions you shouldn't. Sometimes you cut corners. When you raise money for other people, that has to stop. Not saying that it's automatic that every deal will be a home run, because it's not, right? The guy that gets 4 hits out of 10 is in the Hall of Fame in baseball, and he got out 6 out of 10 times. Sometimes people get into real estate and they think, well, it's easy. It's just all going to be roses and unicorns, and it's not. One of the realities that we train syndicators on is you're going to have to make sure that you only take money from people that they can afford to lose, and that you recognize everything isn't going to go perfectly. But once you can get your mind around that and do everything you can to do the right analysis of the deal, the due diligence that's necessary, and feel really good about the project, then it becomes sharing the wealth. And really, that's what this is about. You can keep all the profits to yourself, or you can bring along people who have that problem, and the problem is their money isn't getting to work for them.
Well, I think the responsibility is to make sure that you're matching up the goals of the capital with the projected goals or performance of the project. So if somebody wants cash flow and you're delivering cash flow, that's a match. Somebody wants cash flow and you're delivering long-term equity growth, but maybe there won't be any cash flow for 3 to 5 years, that's not a match. And so even if everything performs according to plan, if you don't match it up properly, that's a level of problem. When we bring people into our Secrets of Successful Syndication training, one of the things we explain to them is there's some core competencies you have to have. You have to be able to sell. You have to be able to recruit deals and capital. You have to be able to provide leadership and communication, because you got to lead the team that's going to do the work. You got to be able to lead the investors through the inevitable ups and downs of the deal and communicate clearly what the goals and objectives are. You need to do great financial modeling, because you're not going to do all the work yourself, meaning you're going to be running a budget. Money's going to come in. You got to deploy that capital, make sure that all the vital functions are funded. Everything's got to get done. If you don't pay for it, you're going to have to do it. And if you don't fund it well enough, you're going to have to do more than's humanly possible. You're certain to drop some balls, and then you're going to have a problem. The other one is due diligence. Due diligence is the work that you need to do when you decide to hire somebody, whether they're a contractor or a counterparty of any type. When you decide to buy a property, you need to make sure that the things you think you're buying are actually there, accurate. If you've ever bought a piece of real estate, and I'm guessing most people listening to this have, you've been through due diligence, because that's what the lender does. The lender makes sure that the property is really there. They do an appraisal. They check title to make sure that the person who's selling the property actually can convey title. They check to make sure there aren't any hidden liens or anything that would encumber the title. They make sure that with your loan that you actually have income. And they don't just take your word for it. They want to see your bank statements, your tax returns. They want to get a W-2 if you have a job. They want to prove that you have actual income. They may do a verbal phone call, verification of employment. They're going to pull a credit report to see what your history is. There's a lot of things. That's called due diligence. It's the diligence that somebody should do. And of course, due diligence is D-U-E, not D-O, because it's what is due or what is owed. But it's a proper level of underwriting to make sure that whatever you're doing is real and actually makes sense. And once you've done all that, there's still a level of risk. And goes back to your point, Robert, is that you're not there to use the money to solve your problem. I need to fund my deal, therefore I need your money, Mr. Investor. No. No, I have a deal that performs this amazing financial result. It produces cash flow, equity growth, privacy, personal use, tax breaks, whatever it is. And you, Mr. Investor, have a need for one of these things. My deal can solve your problem. And if you prescribe your deal as the solution to their problem, and you always maintain that mindset, and you do your due diligence, you have a fighting chance of building a successful business, doing a good job more often than not, to your point, not batting 1,000. You're going to have a deal go bad every once in a while. That's just the nature of the beast. Things happen that are outside your control. But if you control the things that you can control, and you do that well, then you're in a better position to react to the things that you cannot control, like interest rates, taxes, what happens in the economy. Those are risks that anybody who's investing are going to have to face. But you do control the things that you can control, and make sure that you put the right people in the right deal for the right reason, what's best for them, not you first, but them first. And then if you do a good match, to Zig Ziglar's point, you will get what you need. And that's really the essence of the business. And so when you find people that know how to practice that at a high level consistently, then one day you wake up and they have hundreds of happy investors. They've raised hundreds of millions of dollars, and they've done hundreds of millions or maybe even $1 billion in deals. And we're going to get a chance to talk with some of those folks. In fact, one of those guys today, because these are guys that are doing it right.
For more than 20 years, our guest today has been raising money to do bigger deals. He's been in the property management business even longer than that. He's also a great friend and a best-selling author. When we come back, we'll say hi to Ken McElroy today on the Real Estate Guys radio program.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Hey, this is Brad Sumrock, and I'm super excited to share with you about our 6th annual Apartment Investor National Conference, AIM NatCon. This is the 6th year we've done this event, and in the past we've had world-class speakers like Robert Kiyosaki, Grant Cardone, Jesse Itzler, Ed Milet. And this year, it's going to be so many great speakers. We already have some lined up. It's going to be an outstanding event, whether you're new to apartments, already syndicating large deals, already have a successful business. If you want to learn how to make more money and pay less taxes with apartment investing, this is the event for you.
Join the Apartment King, Brad Sumrock, and our rock star lineup of speakers at the 6th Annual Apartment Investor Mastery National Conference, AIM NatCon 2023. It happens in Dallas, Texas, August 25th through 27th, and you get all the details by sending an email to aimnatcon@realestateguysradio.com. That's aimnatcon@realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hi, this is Simon Black from SovereignMan.com, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station all the time at realestateguysradio.com. We are kicking off what we're calling the Summer of Syndication, several shows where we highlight folks that are raising capital and putting together deals that make sense for investors. And to kick it off, we're talking about the real issue behind raising capital, which is protecting the capital. It's one thing to go raise money. It's another thing to do everything within your power to make sure that the deal's solid, the people in it are solid, and the money's protected. We're going to kick it off with one of our favorite guests here on the Real Estate Guys and a super syndicator. Let's welcome back to the show, Mr. Ken McElroy. Hey, Kenny.
Robert, great to be on. Great topic, by the way. Timely.
Yeah, always good to see you. And this is a topic that you and I both have near and dear to our hearts for years. As you've been coming out to our events and things, we often talk about the fact that it seems sometimes the wrong people get in the business. And the kind of people we need are the people who take it seriously, who are good stewards of people's money. And I think as we look at all the great opportunity in syndication, and there's a ton of great opportunity, you're a guy that has raised over $1 billion for real estate deals. I think we have to have a somber attitude that we have to take every safeguard we can when we enter a business like this.
Well, first of all, I believe everyone is pretty well intended. That's been my experience. I really do believe that. I think when most people start off raising money, they are, and they follow a model that maybe they've been taught or learned. But then what happens is it becomes very real when you take the money and put it somewhere. And then you have to kind of decide Well, first of all, you should never do that unless it's a good deal. And I think that's probably something we do need to talk about. But the second thing is how long is this going to last? I mean, you and I both, this is in my 23rd year in business, and I have investors from 23 years ago.
Yeah.
You really are managing other people's money. And I think that sometimes people forget when they're chasing acquisition fees or just trying to keep their lights on or whatever it might be, or they get caught up in, just raising money as opposed to buying the right asset, I think is probably the right way to say it. So, and I believe that what has happened and what we just witnessed, all of us, is that there's a lot of people that are really good at raising capital and they are influencers, but they've never owned property and they've never managed property and they don't have the wisdom yet. The one thing that they can do, though, is sell online. And so that's happening, and it has happened. So it's going to be fun to see what happens now that those fundamentals are going to be tested.
Well, when we talk about the deal, I think there's really three elements that we talk about. We use the analogy of the horse, the track, and the jockey. The track being the market, which makes a difference. So you want to make sure you're in a solid market, depending on your product type. The horse, well, that's the deal. That's, the apartment building, retail center, ground up construction deal. And then there's the jockey, the person or the people who are riding the horse, if you will, making the deal happen. And those are three distinct areas that you have to feel good about in a transaction before you'd even think about bringing your own or other people's capital. Can you speak to those elements?
Yeah, well, and I would add a fourth. I would call it the trainer, which would be the management company or, the person that actually takes care of the horse, which is actually the deal. I think the trainer, as takes a look at the deal. They help you in due diligence. They help you, because if you're going to hand over that horse or the deal to somebody, it has to perform. The rest of the stuff, they're pieces and they're important pieces. Don't get me wrong. But at the end of the day, whatever you say to somebody, they expect. So you have to know what to look for before you buy. So as you guys know, and there's not a deal I've ever bought that I didn't really have a very solid opinion and or business plan on exactly what it was going to do in the first 2 or 3 years. Now, I'm not saying people don't buy that way, because they do, but I don't know if they really understand, the small nuances, because I've gotten a lot of business plans from people. I'll tell you a great story. We decided to sell one property, we don't sell very often, in Houston, Texas. And I got the deal. I went into escrow with a group and they sent me, I was on their LP list. They sent me my own deal with the business plan that they had for it. So I owned it and I got a business plan from them to run it. And Ross and I, we called each other, just chuckled, because I was like, you can literally put whatever you want into a business plan and make it look like you want. And so I think that becomes, the thing that the LP needs to question. And sometimes they just don't know how, right?
Yeah, so true. And I love the nuance of the trainer, because in many of these assets, the person that raises the money is not the manager of the deal, especially day to day, right? You and Ross, of course, a majority of your holdings in the apartment space, and you have employees who work for you, who are on site, who manage the property in many cases, but sometimes you use third-party management, and that's a really, really important piece. And it doesn't really matter what the asset is. It's the big question of, once we acquire this, we're going to have two parts of our plan. There may be a CapEx. We may be doing some work. We may be trying to get up the values like you talk about in many of your books. And or we're going to run this thing for 3 years, 5 years, 10 years. We need a plan for that. And having the right people on the bus at that junction makes a ton of sense too.
Yeah. And I've been in, so my background, as you know, is property management. So when I started in the business in my 20s, I was the trainer. I was the person that people would call and say, hey, we just bought this asset. Sometimes they would call the day before they closed if they were inexperienced. If they were very experienced, they engaged the property manager right when they got it into contract. But nonetheless, a lot of people had great relationships with, we're always looking, and we were always, of course, trying to get the management contracts. So that is an existing business that's available for anyone at any time. It's just a matter of where it comes in the line of when people think that they need it. I believe they need it really early on. And so to your point, what happens a lot of times is those people, they understand what real rents are. They understand what expenses are. They understand what it takes to run something. And so they're a piece no different than the raising capital person. And so what I find, though, what happens is a lot of times, Robert, is we would get hired not knowing exactly how the deal was structured, not knowing exactly what business plan the people invested in, not knowing what kind of debt they were going to have and all that stuff. You know, as a management company, those are oftentimes things that you just get handed. So what happens and what will happen now during this period of time when we're starting to see these rising rates, you'll start to see these syndicators fire management companies. You'll start, because they're not going to take ownership or accountability for purchasing it wrong or underwriting it wrong.
Must be the manager's fault.
Yeah. So that's actually what you're going to see next. You're going to see this wave of management company firing, no matter how good they are, because they're going to keep this thing. And what they're going to do is they're going to write a letter to their LPs and go, oh, I fired the management company. They weren't hitting their occupancy numbers. They're not hitting their business plan. They bring another one in. They bring another one in. And then eventually the rubber hits the road. So that actually is the next wave of stress.
Well, it is interesting if you think about the acquisitions that you guys have done over the years. Very often you bring that strong management sense, and that's because that's your background. Of course, your partner Ross's background in construction and finance, so you have a great partnership in that regard. But I also think that there's this tendency for whatever hat you wear, whatever door you came into, that's what you focus on. So if you're from management, you're thinking about management. So you need kind of everyone on your team to look at those various things. But so many times when we acquire a property, the first thing we do is change the management, because often the opportunity is created because it's been managed poorly.
Yeah, don't get me wrong. There absolutely can be. I bought many places like that where there's low-hanging fruit right there in the rent roll, inside of the operating expenses and all those kinds of things. So in many cases, management companies should be removed. But there's also the other side of it, you know, where somebody just brings a management company on and then there's just no way you're going to be able to hit the numbers because the way that they were underwritten. And so then they fire, and they're just trying to keep, just trying to kick the can down the road. The property manager, in my opinion, is the most important person to engage in the beginning. As you know, I started in this business, so I've seen so much. And then I had to learn how to raise capital, and I had to learn how to sit in front of an investor, and I had to learn, all those things on how to buy these. So a lot of these people that I'm seeing now, they're just online influencers, and they have a big database and they're raising money and they're doing their best to try to find somebody to manage. But the truth is they actually don't know what to ask. Like, they would not know. They would just have to have blind trust on somebody like me if I was managing their property. And then the only thing that it would force would be is if they weren't getting their returns. And then they would fire somebody like me and they would replace it again. And then over time, they would get their learning lesson. But the management is the most important thing. And as you know, Robert, it's also a curse because I've only bought 2 deals in 2 years.
Yeah.
Whereas a lot of people bought thousands of units in 2 years. Now, it wasn't for lack of trying. We underwrote last year 72 deals, and we looked at many deals each week. And because we have an investment committee meet every single week, but I'm looking at the math. I'm not looking at acquisition fees. I'm not looking at the value add opportunity. I'm looking at what does it produce today against the money that I'm raising. Because the money, if I raise money from you, I owe you. I owe you your money back, plus I owe you return on that money. So the only thing on the planet that is going to do that is the actual asset, period. That pays everyone. So if you don't know what you're looking at, you can't pay you back your money plus your return. And so I think that's the piece. The raising of the capital is not hard. It's the execution after.
Well, it kind of, I think people approach it the wrong way. Hey, we're going to raise some capital and we'll go find a deal. The deal has to function before you even get to the stage of who's going to own it. And if you're out looking at these deals, and I know that you say no to a lot more than you say yes to, but I think one of the underlying things that we're talking about, which is critical, and you've mentioned it several times, is underwriting. That is taking a look at the asset in its current state, what the rent rolls look like, what the trailing 12 are, what expenses are, and then applying some of your knowledge and expertise as well as that of your team to say, okay, where are the opportunities? Can we get some of the expenses in line? Can we negotiate better than maybe the previous owner did? Is there a gap between market rent and the current rents? And if so, how much is it? We love real estate brokers, but the broker isn't the guy who knows that information. It is the property manager. So talk about the importance of underwriting, because we've seen this in the last several months. And as you and I have discussed, we're going to see more of the cases where people did not have their pencil sharp when they were doing their underwriting. They got caught up in, well, everybody else is doing it.
Yeah. So great question. So when we do due diligence, you've got your inside, you've got your outside, and you've got your math.
Yep.
Really, that's it. So you have the rent roll, whatever is in place, and then you have the market. That's it. So if there's a gap, there's an opportunity.
Yeah.
If there's a gap because you're going to renovate the unit, then there's a bigger opportunity. So that's what we call a value add. Then you have to take a look at, just like you do in your home, do you spend too much? Like we've all seen people over improve something. Doesn't really matter what.
Yep.
So at what level do you stop in order to get that rent? And at some point, are you spending too much money and not getting enough? So you have the capital on the inside, and then there's a capital on the outside, which, believe it or not, doesn't really bring a lot of money, but is important. So if the outside's not looking nice, the building needs to be painted, it needs a new roof, you need to update the clubhouse, the fitness center if you have one, or the parking lot, and the landscaping and the drainage and all the things, those can be expensive. So those are the three things that we look for each and every time. And each one has to be a hell yes, and then it's just math from there. You just add them up. And we always get excited when we buy from, let's call it inexperienced owners. Yeah. So like one of the things I'm hoping to see is some inexperienced syndicators that try to manage themselves. Those to me are perfect, because I can grab that. I can take a look at that. I know that there's probably going to be value in there, because again, it's no different than somebody trying to be a surgeon that doesn't have any experience. It's the same. Where, I've got 20 some years experience and I've done all these things wrong and I've done all these things right. I'm going to step in and look at the rent roll and the expenses and the property very differently than somebody that's been in it for 3 or 4 years and is just really good at raising money.
Well, and I love the part about figuring out where that gap is. And people have a struggle sometimes thinking, well, wait a minute, why would a current owner not have the markets at rent at the current rate? And it happens all the time. I call it lazy landlord syndrome. You get a owner in there and it's performing well. And, the most expensive things in buy and hold real estate are vacancy and turnover. So why take a chance on raising the rent and kicking the tenant out or them moving? So you get these owners that say, well, we'll just kind of leave it as it is. And they're paying under market, but it works for their numbers. It works for their acquisition price and loan and all that. And you find a way to exploit those things. Hey, there really is some upside there. So that's one angle. And the other angle that you mentioned, the value add, is when you see maybe an amenity that's missing that you could add for a reasonable cost and you'd see that paid back quickly. I know you guys have done that with carports, with adding washers and dryers, looking for the amenities that are maybe missing in the market, not just the rent amount.
Yeah, there's so much. That's why I love this business is there's a story each time. So we bought a 400 plus unit building in Austin where the guy owned it 16 years. He was a little bit older and some broker, convinced him to list it. He listed it. So it was listed. But in that rent roll, we found there were almost $400.
Wow.
In on the average times, 400 some units. So that stuff exists more than you think. Now you got to imagine, why would somebody do that, to your point? Well, they've owned it 16 years. Think about your parents' home. Why haven't they renovated the house in 16 years? It's the same thing. It's like, hey, this thing's kicking off a bunch of money. I've got millions of dollars in equity in it. I'm going to leave some on the bone for the next guy. They're not as hungry as they were after 16 years. It's not always that way, but in this particular case, it was. And then on the value add side, what we also try to look for is vacant land next to, a property so we can expand it. So we've done that. We bought 150 units and added 120 next to it, brand new, using the same clubhouse. There's that, certainly. And then there's all kinds of ways to add value, like carports, stuff on the inside, dog parks. People love yards. There's so many things that, especially today, work from home, people want. If you just keep meeting the demands of the customer, you can actually charge for a little bit here, a little bit there. I'm talking about $5, $10, $20, $25 a month stuff. This is not big rent increase stuff, but over a period of time, it starts to add up and it creates value to the property.
Boy, it sure does. Even $25 times 400 units times 12, right? And now you look at a cap rate and say, man, that really does increase the value, not just to your current investors who'll be the beneficiaries of the cash flow, but also if you decide to refinance it in the future or another buyer comes in. And let's face it makes life better for the tenants. I think apartment owners sometimes get the bum rap of being slumlords, and there certainly are those kind of folks. But for the most part, we get to provide clean, affordable, safe housing for folks who maybe aren't in a position or aren't in that stage of life where they're going to go buy a home. Well, they can rent affordable property from us, and it can make us and our investors some good money, but we do have to be careful as we select properties. Our guest is Ken McElroy. When we come back, we'll talk to Ken about the people side of the business, how we make sure we do our due diligence there, and we'll play real estate trivia, give a copy of one of Kenny's books away next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've ever dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2024 Goals Retreat, January 12th to 14th in Dallas, Texas. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at goalsretreat.com. Get your life back on track, physically, spiritually, and financially. Attend the 2024 Goals Retreat on the second weekend of the new year. Visit goalsretreat.com to learn more and get on the advanced notice list. This is no dress rehearsal. Live the life you were meant to. Visit goalsretreat.com or call 888-489-7723 extension 18. That's goalsretreat.com.
Hi, this is Dennis Waitley, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, make plans to join the Real Estate Guys in beautiful New Orleans, Louisiana at the 49th Annual New Orleans Investment Conference. Takes place the first week of November. All the details are available to you if you send an email to neworleans@realestateguysradio.com, neworleans@realestateguysradio.com. It's the first in our summer series of syndication. We're talking about raising capital and the duties and responsibilities that lie therein. Before we get back to our interview with Ken McElroy, it's time to play Real Estate Trivia, your chance to win a prize by knowing today's Real Estate Trivia question. When you hear the question and think you have the answer, send your best guess to trivia@realestateguysradio.com, trivia@realestateguysradio.com. Give us your name, your mailing address, and the answer to the question. First person that gets it right gets an autographed copy of Ken McElroy's awesome book, The ABCs of Buying Rental Property. That can be yours if you know today's real estate trivia question. Last week, we were talking about getting started early, and we heard from some successful young investors. Here was last week's question. Star Wars fans have the opportunity to spend the night in Luke Skywalker's boyhood home as depicted in Episode 4, A New Hope. Where's it located? Well, the actual property is in Tunisia. It's called the Hotel Sidi Driss, and it's in Matmana, Tunisia. I'm sure your stay there will be out of this world. Here's our real estate trivia question for this week. Where's the largest library in the U.S.? Yeah, of all the libraries, and there's some big ones, where's the behemoth, the biggest library in the United States? If you know or just want to guess, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Give us the answer to the question plus your name and mailing address. The first person that gets it right gets the ABCs of buying rental property signed by the author. That's today's real estate trivia question. We're with the author of that awesome book, Mr. Ken McElroy, talking about the syndication world. Does it make sense for you to consider raising capital to do more deals? And if you've already got a great market or markets, you've got a great team, and you could do more if you had more capital, then maybe you're a candidate. But we wanted to start this series by having a sobering conversation about it's not just get rich quick. It's not, hey, just go raise a bunch of money because, you've got a following. It's doing good, solid business that you can repeat. We often talk about not swinging for the fences, but these repeatable base hits that over time do well for you and your investors. Kenny, we were talking about, the property and the rent roll and taking care of not only looking at the horse, but the trainer. Let's talk about the jockey. Let's talk about how you vet the people involved in a deal.
Yeah, well, there's as you can imagine, at this point, right now we have 300 people working for me, and over the years I've had thousands and different companies and all that. And first of all, one of the things that I've learned is that this is very much a customer service business, and the resident. I think a lot of people forget about this. And nothing works unless the resident is happy and they're being taken care of. No different than you would expect if you were at a restaurant or a hotel or whatever it is. So it's that. And so I think a lot of times people focus on the money, they focus on the rents, they focus on the rent roll and all the things. And those are all important to look at. But at the end of the day, we call it sharing the good life. We have to always take care of everything happens at the tenant level, every single thing. So if they, and so most of my time is spent on customer service, tenant issues. We have a full-time person in-house customer service, basically. Her entire job is for inbound. I take this so seriously, Robert, that we actually created an app for our company, MC Companies, where they can text. Tenants can text. They can text maintenance things. They can text questions. They can text the corporate office. And then we have it automated so it rolls into a customer service. Because I want, obviously part of this is obviously getting my Google ratings and my scores and all that stuff online, just like you would look at a restaurant. When you go look at a restaurant or a hotel where you're going to stay, you look at the star rating, same thing with apartments. So this is the key to everything. In my opinion, it's that simple. If you can just find people that are nice and nice to people and customer service oriented, you can train the rest of the stuff into them. You can train the accounting and the numbers and any reporting and and how they run their staffs and all that stuff. If you just can't replace kindness and energy in a person. So for us, we hire by attitude. I hire slow and fire quickly. And we hire by attitude. And I believe that, the person with a great attitude, what they do every single time, if you give them a task, when they're done, they go, okay, I finished that. Can I have another one? Because they're trying to learn. Whereas there's other people that they just want the job, want the paycheck. There's nothing wrong with that. I have no problem with that. They just don't have a room in our company for that.
Yeah, it's such a good point. And I'll tell you, over the years, you've been kind enough to allow us to come in and look at a couple of your properties on our field trips and those things. And every time I come into contact with one of your team members, they're just joyful. It's crazy. I remember we would talk to one of your managers in Dallas, and afterwards the group, we had like 50 people on the bus, and they're like, gosh, she was just so nice. She was just so friendly. Mm-hmm. I'm like, yeah, isn't that amazing? What a shortcut that is. But I think it underscores this whole idea that without the tenant, there is no performance. The tenant isn't an inconvenience. The tenant is the reason we have these businesses to start with. If you take care of a tenant, you'll have less turnover. If you take care of a tenant and have good service and respond when they have an issue, they'll stay longer, they'll refer their friends, and they won't mind that occasional rent increase as much.
Right. And I'll tell you, we were talking before the break about renovations. So a lot of times people are like, you're kicking people out. That's not at all what happens. Somebody moves out and then we renovate that unit. And actually, you know who rents it? The people that live there.
Yeah.
And those are the people we show first. We're like, hey, it's a little bit more money, but you got new flooring and new appliances and you want to take a look at it. If you like the community, go over here. And it's a pretty high probability that a lot of them say, yeah, this is great. It's newly painted. It's got all this new stuff. I think, we like it here. We're just going to re-sign a lease here at a higher amount in a renovated unit. And then that gives us an unrenovated unit to renovate. Now, it doesn't always happen that way, but that is life. People are always looking to upgrade. If we've got a 15 or 20-year-old stove and refrigerator and they can rent one, that's completely brand new, basically, we've done almost everything inside. Oftentimes they do. So again, going back to what the customer wants. And if they don't want it, then that's fine too. You just rent it to somebody else who does want it, but we would never, ever create a vacancy to do that solely. You wait until they move and then to provide that opportunity for the next person.
Well, and in multifamily, this is true in other real estate sectors too. When you are looking at repositioning units in the way that you're talking about, it takes time. You have 200 units, you're not going to renovate those in 6 months. Mm-hmm. And part of the time is just what it takes crews to go through and logistics and supply chain. And part of the time is exactly right, the natural occurrence of a tenant getting transferred, moving out of the area, deciding they want to move up or down. And when it works out well, you really can raise the value. And it's so much easier to keep an existing tenant than it is to have to go out and find a new one.
Yeah, without a doubt. I mean, we actually armed our on-site people with several $1,000s in cash and said, use it from your discretion, because people come in with stuff, this happened, or the tenant above me, ran their tub and it's linking into my bedroom or whatever it is. And we're like, no problem. We'll put you up at a hotel.
Yep.
Just like that. So those are things that it's day-to-day life. You have to address it no matter what it is. And the site managers, we need to empower them to be able to do whatever they have to do from a customer service standpoint, And so that, to me, Robert, is the key to the whole business.
Love that. Hey, Kenny, in the last few months, there's been some trouble in paradise. We've seen a couple of big apartment syndicators lose properties. We've seen the investors lose money. Last time we had you on the show, you talked about a cash-in refinance, which worked out okay, right? But that's not something we're used to hearing. There have been syndicators out there investigated by the SEC, all kinds of allegations. So let's just talk about what it takes to be in this business long-term like you have and avoid some of the landmines and pitfalls that are out there.
Wow. Well, yes, obviously that's certainly concerning. Again, it boils down to the underwriting and the management after. These are folks that largely, raised capital, and people blindly invested in whatever they invested in. And I think it's a complex problem. Like the example I made before with the business plan, that you could make a business plan, whatever it is. That's a document that people can turn to. That's why that's an important document. That business plan is an important document. So those are the kinds of things that are going to be up for scrutiny. And then the other thing is when you get into a situation where you're promising a return, then that is subject to scrutiny as well. And I've seen that a lot happen over the years. And so the proper thing to do is to overperform and have a range of a return and outline all the risks in the business plan. Say the market could change, this could happen, and these are the, and you need to be able to just show how thorough you work, because things can happen. I bought properties before, and we've had surprises as well. Everyone has them. And that's the time to communicate too. So, what we're seeing now, there were a lot of people, again, this is just words from somebody who's, had some experience here, a little wisdom. We bought rate caps even when we didn't think we needed them, because at the time they were 25 to 50 grand. You can throw stones at those people, but they didn't know any better. And so when they were offered it, like, well, why would I need that? Rates are going to be 3% forever. So, again, this is just experience.
Yeah.
And then also, as you start to run out of cash, what kind of cash reserves do you have? What's your plan if rates go up, we'll hit the cap? And, how are you going to be able to recapitalize this deal later? And how's all that going to look? So these are things that, we have experienced in our 22 years. And so when we're buying something, it's like, I've been at this table before, and so they're just little subtle things that you're putting in place to anticipate any issues that might come down the road. And so what's happening is everyone's hands are getting exposed. And in a lot of cases, they've oversold the return, they've oversold what the property could do, and they've put very poor management in there, and who knows what else. So that's all getting exposed. I actually believe, I'm doing a video, it's coming out on Friday, that I'm calling Red October, which is there's $8 billion of multifamily bridge debt that's maturing in Q4. So, and by the way, that's just a couple months away. So I think with what we have going on with office buildings and what we have going on with multifamily, we're going to see a very interesting Q4 2023. So I believe, even everything we've seen so far, I think we're still in the first couple innings. I think you're going to start to see the cards, the real cards here toward the end of the year in the first quarter. So it's going to be very, very different 1 year from now.
Well, and you can see, it's that whole thing about when the tide goes out, you can see who's swimming naked. Folks who maybe cut some corners on underwriting, it wanted to fit into their buy box, and they're like, well, it's too high of a price, but we want the deal. And I've watched you guys be methodical about sticking with the price based on the value you've calculated in your underwriting, and you don't get emotional about it. If the price gets bid up, you're like, well, we're not the buyer. And I think there's that attitude that makes sense. But let's also talk about the capital raising part in terms of suitability. There are certainly exemptions that we use from registration, and some syndications are for accredited investors only, with the thought being, well, if someone's accredited, then they've got the financial and we would hope other wherewithal to make the decision. But even if they're not accredited, they need to be able to show a level of sophistication. But I think this is another area people have run into trouble. You mentioned that the business plan is going to have all the risk factors, and that's important. And that's part of the plan. Literally, we may have to call and ask for more money. No one wants to make a cash call, but it's a reality. If it's in your documents and you talked about it with them, they're not happy to hear that news, but they're also not that surprised because it was in the documents. It's when you don't say anything. So I think we're seeing cases where people maybe took too much money from an investor or let the investor get too excited about it. Well, sometimes we have to sober the investor a little bit. They got all intrigued and they get on your list and, your stuff funds really fast and there's that, urgency. How do you make sure that it really is a suitable investment for somebody?
Yeah, it's a great question. So, it's pretty black and white as to what's accredited and what isn't.
Yeah.
So that thankfully is not subjective.
Yeah.
So if we have an accredited investor, they've been vetted, they're on our list, they've gone through the process and the SEC pretty much tells you the rules.
Yep.
Then from there, I think it's our job to outline all the pros and cons of the investment. So it's very common for me, Robert, and Ross, my partner, as you know, my amazing partner, to say this could go to zero. Our investments, are at risk too. And by the way, I invest alongside everyone in every deal. I'm in every single deal we have. So,
yep.
It's my money alongside of other people's money. I think that's an important piece that you would want to ask is, so it's, we don't put a ton in every deal, but, anywhere between 100 and 500 per deal, we have real money alongside everybody. I think that's super important as well. But ultimately, we always like to say that if something's going sideways, it needs to be, you need to be transparent, and your reporting. And I think that, that's what I'm hearing now is those kinds of things. Now, what's the irony is, I don't know, I took back over my management company in October, November last year, and I hired a new president who just started July 1st.
Yeah.
But we're on track. Our company's on track. We're beating budget by $8 million in cash flow. So, we're just through the first 6 months. Now, not on every asset, right? Some assets are more, some assets are less. And so, you got to take the wins on the ones that you've done really well on. And then you have to be super transparent on the ones that are in trouble. So we have, we still have a handful of properties that have some of these rate cap issues, right? And we're working through them as well. Now we have the money, we have the capital, we have a plan, and we actually have multiple plans, as you would imagine. And that's just being communicated to everybody. This is what we've got going. This is what we're planning on doing. This is where we are. And that's, I think that's the level of transparency that these investors deserve.
Totally agree. I remember you were at our Secrets of Successful Syndication at the VIP lunch one of those times, and you had a great expression. And it is as simple as delivering bad news builds trust. When there is we all want to deliver good news. We all want to call up the investor and say, hey, we beat budget. Hey, we're making money. But when stuff happens the other way, human nature is to avoid it. What you need to do is pick up the phone.
Yeah. I'll tell you something crazy that happened. Like, this is actually just blew my mind. So that example that I said, we literally are about $4 million ahead for the first 6 months of the year, above budget.
Yeah.
Right. So I was like, oh, this is going to be great. We're going to, let's tell everybody how great we've done, the budget's. Well, then, what the disruption that's happening in the insurance world.
Right.
So we're seeing 30 and 40% insurance increases.
Yep.
So my insurance premiums are over $3 million a year. So that means I got a $1.2 million issue or $100,000 a month.
Yeah.
So all of a sudden, now I'm like, oh man. So all of a sudden, all that success I had, the letter is actually going to say, it's great that we had success, but we're now going to escrow 40% increase. I don't know if we're going to have an increase in November of this year for our insurance premiums, which we think, and we're being told are going to go up in 5 months. So again, that's managing the cash. I could have very easily distributed that and then learned about that bill in November, because guess who impounds insurance? Lenders.
Right.
And by the way, it's paid in advance. So you have to have, imagine I have to have a $3 million bill owed November 1st, and I would have been 40% short because of the increases. And so again, it's just communicating with the investors about things like that. Say, by the way, it's their money. Don't get me wrong. We're just going to hold it in their account, and we're going to wait and see where our insurance pricing comes in. And then we're going to pay it, and then we'll distribute, and then we'll have just escrow for the next year. But that's active management, and that's active transparency.
Love that. And great note to end on, that it is their money. And we have to not just treat it like it were ours. We have to treat it way better than it was ours. Great stuff today. We appreciate you. Thanks so much for being back on the program.
Absolutely, man. Good luck to you guys. I miss you.
There's Ken McElroy. You can check out his podcast, Real Estate Strategies, and all things Kenny at kenmcelroy.com. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
If you've been listening to the Real Estate Guys for a while, then you've heard about the legendary Investor Summit. Simply put, it's the highest level event we do. And the content, faculty, and attendees are amazing. If you're serious about taking your real estate investing to the next level, consider joining us. You'll spend more than a week with like-minded investors, world-class educators, and real-world professionals, and you'll have a blast. It all takes place next summer, so to get the details before they're released to the general public, send an email to summit@realestateguysradio.com with the subject Summit 2024. We'll add you to the advance notice list, and you'll be invited to spend a fun-filled week learning and networking with more than 25 class sessions and breakouts, plus small format roundtable discussions, great dinner conversations, and a ton of fun. Send an email to summit@realestateguysradio.com with the subject Summit 2024 and be among the first to get the details to join the Real Estate Guys and an all-star faculty on the 22nd Annual Investor Summit. As I speak, inflation is robbing you at a rate north of 10%. Last year, the number one zip code that Mid-South homebuyers offered income property to Real Estate Guys listeners in appreciated by 21%. To harness that spread and protect and grow your wealth in the current economic storm, you need the 2 decades of experience in renovation and management that Mid-South homebuyers brings to their investors. Every home Mid-South offers you will have brand new components, a new 30-year roof, and a high-quality renter, all in a price range under $150,000. Their empathetic property managers will use your ROI as their North Star, while the lack of repairs on their totally renovated properties contributes to their almost 4-year average renter stay and 99% occupancy rate. Learn about their lifetime occupancy guarantee and total 1-year maintenance guarantee by emailing midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. You'll be glad you did.
Hi, I'm Aaron Katusa, the chairman of Katusa Research. You're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show. Hey, if you'd like to do bigger deals using other people's money or figure out how to come alongside bigger investors doing awesome stuff, come on out to the Secrets of Successful Syndication. Happens October 6th and 7th in Dallas, Texas. Find out more on the website at realestateguysradio.com under events. Well, I tell you, it's always great to hear from Kenny McElroy. Not only does he practice what he preaches, he is an excellent teacher and remains a fabulous student.
Kenny exemplifies a lot of great things. And if you ever get a chance to get around Kenny live and really get a chance to observe his life or listen to him talk freely, he drops these gold nuggets so effortlessly.
Yeah.
And if you're not paying attention, you'll miss it. And we have so many great Ken McElroy quotes. But one of the things that I've learned as I observe Ken is that he keeps things simple. Number 2 is he treats everything like a business. He's very serious about the business side of things. In fact, MC Companies, a company he and his partner Ross created, has been voted many times one of the best companies in the state of Arizona to work for. So it's not just investing. It's not just raising capital. It's not just doing deals. It's building and leading a team that's following a set of systems and processes and has infrastructure that all has to be maintained and improved perpetually, because that's how you really scale. And we first started learning about some of this stuff. He recommended a book called Scaling Up by Vern Harnish. You've read it, Robert. I've read it. And that's kind of along the same thing with Gino Wickman and can't remember the other co-author in Traction and the whole EOS system, belonging to organizations like EO, Entrepreneurs Organization. He practices what he preaches in terms of attending conferences. We have this picture of him one time. We were asked to speak at the National Apartment Association. And we were looking at the website and trying to just get a feel for who they were and what they were doing. And right there in the picture, sitting in the front row, one of the sessions was Ken McElroy taking notes. And so to your point, Robert, he is a great student, but he's also a great teacher, and most great teachers are great students. He's a great businessman. He's a great investor. He's a great syndicator, and he's a great guy. So happy to have him on the show. He's so generous at this time. Very grateful to have him here today sharing his wisdom with our audience.
And I think one of the things Ken really believes is that the syndication business is a fabulous business, but it does require that little extra bit of care as opposed to the things we do on our own account. We can be sloppy when it comes to our own numbers, and you hear people in syndication teach you have to treat it like your money. No, you don't. You have to treat it way better than your money. And you can't prevent bad things from happening, but you can certainly put yourself on the side of success if you'll just follow a few prudent steps. In the next few weeks, you're going to meet lots of super syndicators, folks that have raised $10 million, $30 million, $100 million and more, and we'll get some great lessons along the way. We hope you enjoy this series, The Summer of Syndication. We'll have 2 more amazing syndicators next week. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.